So, Lyn, let's just jump right into the discussion here today. So, in the research paper titled The Best Strategies for Inflationary Times, the author looked back to 1926 and studied the 8 different inflationary regimes, which was 19% of the time. So, I'm just going to throw some stats out there. If we look at equities in those inflationary times, equity had a negative real return of minus 7% and a positive 10% real return whenever it was not. And over the entire period, the real return for equities was 7%. Now, let's turn to commodities, which is one of the main topics here for today. Commodities netted 41% in times of inflation, but minus 1% in non-inflationary periods. And then for the entire time period, commodities had a 3% real return. So that is in comparison to the 7% real return for equities. So, in other words, if you don't have any opinion, it's typically better to hold equities than commodities. But what if we can get the best of both worlds? You want to skew your portfolio in the direction of where you see inflation go. But as the proverb goes, it's difficult to make predictions, especially about the future. So before we discuss where we think commodities, gold, and inflation are going, let's start with the basics about commodities. Why do commodities perform well in inflationary times?
Commodities tend to do well in inflationary periods almost axiomatically, because if you have a period of high inflation, it means that things are going up in prices, particularly commodities. You don't really see any inflationary periods where commodities stayed super low. Technically, you could have, say very specific supply chain disruptions where somehow commodity prices stay low, but that inflation's high. But that doesn't really happen in practice. Generally, inflation is a result of usually issues on the money supply side, and then also something related to capex and undersupply on the commodity side, because commodities go through these big cycles. And as we should expect, things that are able to compound and grow should outperform things that don't. And so a company that has thousands or tens of thousands or hundreds of thousands of employees working every day to make that company better should, over the long run, outperform just like a hunk of metal or a barrel of oil. But basically, the thing that both stocks and bonds have in common is that they do very well in disinflationary regimes, basically stable monetary conditions, good long-term planning and pricing power, whereas commodities are the best hedge in those more inflationary environments. And so there's multiple ways to defend against inflation, but having commodities in a portfolio or commodity producers in a portfolio is one of the cleanest ways to do it. And you can either do it in terms of a permanent portfolio approach where you always have some slice of commodities that will be an underperformer much of the time and then a dramatic outperformer in some of those times where equities and bonds don't do well. Or if you're more active, you can tilt towards commodities around the time that you expect inflation or you're seeing signs that inflation is starting to build. If you, for example, follow the capex cycle more closely and have a better grasp on inflation than maybe the average market participant.
So, Lyn, one of the typical arguments for buying gold is to have an asset outside of the financial system. I can't help but wonder, how does that translate into investments in commodities? Many of our listeners, due to what you said before, in terms of managing their portfolio, they might want to own an asset that perhaps correlates with the price of a specific commodity. It could be oil, but they're not keen on holding the actual commodity. So how can investors, if possible, get the best of both worlds?
So gold and commodities can almost be considered two different asset classes, because although gold technically is a commodity, it has more characteristics of a currency. And what I mean by that is, so most commodities have a low stock to flow ratio. Basically, the amount that we have stored in the world is in many cases lower than the amount that's produced annually, or maybe it's 1 or 2 times it's produced annually, depends on the specific commodity. There's not very large inventories. Usually they're very bulky. They don't last a long time necessarily, and they require expensive storage facilities. And so we have rather low inventories at any given time. And so those are necessary inputs into the economy. And that's why they're so closely tied with inflation, because if we have shortages in those, pay more to get them, we squeeze other parts of the economy. Whereas gold, because it's the vast majority of it is not really needed for things. I mean, there is an industrial use for it. It's usually a small percentage of the price of the good that it's going into. And most of it is used for jewelry or just outright monetary use or store of value purposes. So coins, bars, as well as jewelry that in many cases, especially in some countries like India, very much overlaps with the store of value aspect of it. It's another way of storing value. And so gold is, in some sense, it gives us that long-term protection against inflation. If you have, fiat currencies going down in price, down in value, gold over the long run has historically held up equal to or actually better than official CPI, closer to money supply growth. And the advantage of it is because it has a high stock to flow ratio. So it's not like disruptions really affect the gold market too much. And two, because you can store a lot of it for a long time in a small amount of space, it's one of the rather few commodities that can be suitable for people having some at home. They can have gold coins at home. And the main advantage there is, a lot of us are in developed markets, and we've had this very long period of stability where something like having gold in your home sounds totally unnecessary and kind of silly. We trust our financial institutions. Whereas, for example, right now, when we're seeing currency crises in different countries, some of them have bank bail-ins when that happens. Some of them have, hyperinflations happen, right? Not just going back to Weimar, but in some emerging markets today, you have either outright hyperinflations or you have things that might as well be, right? There's double-digit inflation, super high, maybe doesn't meet the definition of quote-unquote hyperinflation, but it's a destruction of currency. And then in those environments, usually you have, even if say you're in Lebanon and you're storing dollars in the bank, or Argentina, basically there's a precedent where they come in and say, okay, we see that you have dollars, we're going to go ahead and take those because we need them, and we'll give you our local failing currency in exchange. And that's something that basically anything that has counterparty risk, when you have a truly inflationary or really kind of problematic financial environment, you can't necessarily 100% trust your cash assets, even your stock assets. Whereas having physical self-custody gold, or say gold stored in a private Brinks vault or something like that, is just another lever that those, say, authorities would have to go through to basically defraud you, to take your assets or forcibly convert your assets. And so in that way, it serves as insurance. Whereas commodities, if you say invest in oil futures or oil stocks or copper stocks or things like that, they're not giving you that defense against that confiscation type of approach. But instead, that's more of a normal financial play within the confines of the financial system. So you have, say, copper stocks for your broker account, for example, and that's just giving you a strong inflation hedge. So if you go through a more inflationary environment, a period of more commodity shortages, those should be good hedges for your portfolio, not necessarily in the same sort of like disaster scenario that gold can protect against, but in that more directly inflationary environment. And as you've seen, for example, gold, because it has this high stock to flow ratio, it can behave oddly, right? So you can have 7% inflation and gold not do well, whereas the other commodities are actually in some ways better inflation hedges, in the sense that almost by definition, if you have high inflation, it means most of those are probably doing well.
I also think whenever it comes to, say, gold, it's so different what people hear and how that's perceived depending on where you live in the world, perhaps also depending on your age. I live in Denmark, and every time I bring up, say, something like Bitcoin or gold, people are like, that makes no sense. Why would you do that? Like, Danish kroner, it's a good currency. What's wrong with that? How can anything go wrong? And they would say, invest in stocks if you want to make more money. And then if you go to Asia, they would say, gold makes a lot of sense. That's safe. Don't speculate in stocks. And I know I'm overgeneralizing here right now, but I just think it's very interesting whenever we're having this discussion about gold and currencies, how that's just thought of so differently depending on where you are. And yeah, I guess the experience is not just of your generation, but also your parents' generation.
Yeah, it's interesting because if you look at different stock markets around the world, many of them have had 10, 20, 30-year periods of very poor returns compared to just even in dollar terms, let alone in gold terms. And so partly where you go in the world will dictate how they perceive stocks. In the United States, where we've had one of the best performing stock markets, especially over the past decade, but going back a number of decades, people have this idea that stocks only go up, and they go up at like 10 to 15% a year, almost like clockwork, or more than that in bull markets. And why not just invest in that? Whereas if you go to many other jurisdictions around the world, that's not necessarily the case. And then, as we talked about before, basically in disinflationary environments, stocks are among the best investments you can hold. And the world has been in, we've had some inflationary bursts over the past 40 years, but for the most part, we've been in this kind of 40-year disinflationary period. And so a lot of recency bias really focuses on the power of stocks. And I think that's one of those things to be mindful of going forward, is to try to avoid that recency bias. Now that we've gotten all the way down to like zero interest rates in many places, now that stock valuations are very high in many places, we shouldn't necessarily expect the same amount of broad stock indices that we've come to expect over the past 40 years. And I think some markets, I kind of ironically, the markets that have done poorly, I think that people are more attuned to that and might, navigate that better than people in markets or that invest in markets that have just gone up for, 40 years almost, especially the past 10 to 15.